As the chief economist with Annex Wealth Management, where do you see the threat from the geopolitical situation and the escalating tension between Israel and Iran? And how much of this do you see as Mike was pointing out, as yields and earnings and other factors that are weighing?
Yeah, thank you for having me. So when we were discussing it in our investment committee, we were thinking that today's moves were more like related to the move up in yields as opposed to anything going on with Iran and Israel. If anything, maybe we were starting off the day with a little bit of that relief rally, that things weren't escalating and spreading. And so we think that right now the story is more about the strong retail sales report and what that then means for Fed policy, the move up in yields. And it's interesting how tech stocks have once again become really strongly sensitive to the movement in yields. For a while, they seemed like they could move their own way, but now we're back to the future, back to the old days where higher yields, lower tech stocks because of when you're discounting those future earnings of those big growth companies.
Does that argument extend to non-tech growth companies as well? So you would therefore favor other kind of categories of equities?
Yeah, we really do think so. You know, obviously, in an environment in which growth seems pretty good, there isn't a lot of scarcity of growth. And so investors might not feel like they really need to pay up for growth. And instead, you're seeing the moves, let's say, with the financials today, Goldman Sachs, M&T, Charles Schwab doing quite well because of those earnings beats. So those aren't exactly your growth companies, right? Those are more related to financials, more cyclical. We actually think that it's a pretty favorable environment for on these dips. As Mike was talking about before, 3.5% off with the S&P 500, maybe it goes down a total of 5% peak to trough. That becomes to us a very buyable dip opportunity for more cyclicals, let's say for small cap, mid cap, more on the value side of the spectrum as opposed to looking at the large cap growth.
You've got a lot of duct tape in your research. You're saying that the consumers spending on services is duct tape holding the economy together. Why do you think that? And where does the duct tape start to fray?
That's right. Yeah. So they're kind of using that analogy about why is it that the economy has been doing so well. And it's really two sources for that. One is if you think back to last year with the Silicon Valley Bank failure, the Federal Reserve stepping in with the FDIC, basically using some sort of monetary duct tape to kind of keep things together. But then also for the broader economy with growth, it's really been about consumer-led, and especially on the services side of things, that's been the duct tape keeping things together. Now, we do think that we're likely to see the service sector activity begin to slow a little bit. Maybe we got an early indicator of that with the retail sales data. The food service with the spending at bars and restaurants was up only 0.4% month on month. So that was a fairly tame increase. So if service sector spending slows, maybe business spending and investment spending can really pick up the baton, as we already did have an earnings recession in 2022 and part of 2023. So maybe business spending is the thing that needs to take up the baton now.